Most investors follow trends. Very few develop edge. This show focuses on something different: how serious operators build durable wealth in overlooked niches, starting with mobile home parks. We'll break down the strategy, underwriting, discipline, talk about the roadblocks, and the operational execution that'll make your capital aligned with long term returns. This isn't about chasing deals. It's about thinking like an allocator and executing like an operator. This is the Mobile Home Park Exchange. Today's guest on the Mobile Home Park Exchange podcast has taken a path that you don't see often. He was a Tesla salesman running a very effective team at Tesla. He was an LP. He became a real estate agent. He went to the institutional world running the acquisition team for a real estate fund. And now he's runs his own platform, Cornell Communities, where he owns approximately about 500 communities, 500 units and about 30 million under management. But what caught my attention about this guest isn't just the growth, it's how Leo talks about the business. He leans into his philosophy, leadership, stewardship, and building something with intention. And I'll be honest, in a space like ours, right, in the manufactured housing space, that can be a real edge if you could put that philosophy into execution. So today I want to get into some real questions. What actually works, what breaks at scale, and where does the operational reality and the philosophy tie together? And with that, I want to welcome Leo Young to the podcast. How are you today, Leo?
I'm doing great, Frank. Thanks so much for having me on.
Well, I appreciate you being here. And I know I've followed you for a while and I've seen, what you have been doing and the growth that you've had in this industry. And at this stage, call it somewhere, depending on the day and the valuation, you're probably between 30 and 35 million AUM. Is that correct?
More or less. It depends on the cap rate, this, that, the other thing. But yeah, more or less like 25, 30, I think is like more accurate.
So I when I see that, right, for me, that was a very weird stage, right? It was great because it's all of a sudden you reach that next, that next mountain, right, that you've just hit. But it's also the part where I started to realize myself, I couldn't do everything myself, right? I couldn't be the one answering the phones. I couldn't be the one doing the things that I was doing. So at this point, like once you started hitting that 400, 450, 500 lot level, what all of a sudden got harder for you?
I think the biggest realization, Frank, is that you are not the machine anymore. Is that you separate from you versus the machine. So when you start off, like, a lot of real estate investors, they are buying their first flip. They're like, yeah, I'll pop over on a Saturday, I'll bang out a deck, I'll do this, I'll do that. But when you build up, there's only so much you can do. And it's not to say that you're not capable as an entrepreneur to like run all these communities. It's more so like you shouldn't be that guy. Because when you build out operations, like, yeah, there is a lot going on. There's a lot of firefighting day to day, and you shouldn't be that guy to do everything. So consciously putting in systems, putting in the right people into place, and training them, empowering them to do what they do best in their role, I think that becomes the more important focus as you kind of grow past that point.
So one of the challenges that I faced with that, and maybe it's the challenge that a lot of entrepreneurs face, right? It's the fact that I know I can do it, right? And I might not love doing it, but I know I'll do it and I'll get it to where I want it to be. And then when you talk about bringing people on and you talk about, training them to do certain things or to do certain tasks, they're not going to do it the way you do it, right? And so living with that or accepting that, how was that for you? and how does that impact your growth?
So the nuance is that there is no single right answer, or there is no, I think it would be great if there's a rubric like if this happens, then that. But you as the entrepreneur, as the investor, as the leader, you kind of have to build your own rubric as you go along to figure out when do you step in, to what quality do you want this job being done. So Dan Martell, he's got this book, Buy Back Your Time. He mentions that 80% good is 100% done. So done is better than perfect. And sometimes I think it is that letting go. It is that, like, okay, like I trust this guy to figure out the issues if it comes up. If he's going to say something that's like not detrimental, just let him fail and figure it out, and be there to kind of guide him after the fact if so. And that's always tough. I think as entrepreneurs, like, you kind of get to this level by doing everything right, and like your brain is just constantly working. Like, my brain never stops. Like, like late at night I'm still thinking, I'm still talking to AI or whatever, on like what can and would be done. But that's not how you grow, and that's not sustainable. So I think you become kind of the somewhat of the ideas person, because you need to get your team behind a vision, but you're also the kind of jockey in a sense. Like, you want to give people the right guardrails, the right systems, the right tools to succeed, and then also like check in to make sure things are done. You're not at that stage where you can just let go. You can't like completely delegate and just like go somewhere. It is still very hands on, and like I'm at that stage where it's like it's hands on leadership. I mean, it's very rewarding in that you're developing someone and you're seeing them grow, you're seeing them understand certain things. But yeah, right now it's a bit of everything.
So I had, when hearing you talk, and I remember very succinctly, I had a coach tell me, when sharing some of the same things that you're saying right now, where you feel like you've got to carry the load, across the finish line all by yourself. And they gave me the description of a rocket ship. And when a rocket ship takes off, right, it has the entire payload, but the higher it goes, the more it has to let go, until finally it's the smallest piece that gets to the top, right? And that's focusing in on your own unique ability and doing the things that you do best that nobody else in the organization can do, and getting, releasing the things that other people can do. And I think that's such an, and that's always evolving. It's never going to be the same, but that's such a key component to growth, to getting you to that 30 million AUM, to getting to that next step at that point. One of the things, Leo, and I've heard you say this before, right? And this really resonated with me because I found it very similar to our own experience when Eric and I were building. You started with third party management, right? Was that like your first community was
Yep.
third party management?
Third party manager. I mean, we still have some. I think we're
Okay.
we're transitioning to some in-house and like building out the capabilities there. But
Yeah.
I mean, as you know, like property management, that's like it's just like a never-ending kind of like cat and mouse game. You're like, you fix one thing, another thing comes up. So like there is no perfect solution out there.
Yeah, and then, but yeah, you're making the shift, or you made the shift to in-house, right?
Mhm.
What was it that made you realize, like, hey, this has got to come in-house?
Two things. One was that I found myself getting into the weeds too much, because we had a couple different third party management companies that we were working with, and then for one company it's like, okay, I have to do this and that. For the other company it's like, I have to do this and that. And I think it just creates cognitive friction, like, because then you have to like shift gears a little bit and be like, okay, I guess for this one, how do I support this property? I would do this and that. So I think that was what led to the thought that, okay, let's let's get our hands dirty and our feet wet, and just try to build this thing out for our own liking so that we can do it better and we can have a more comprehensive solution and do it in a more cost effective manner. Because I think the property management business, I mean, it's a tough business, right? If you're fee based and you're like delivering value, you're not getting the upside. It just really is like, where is your attention? And like, you have to get enough properties for you to be able to hire people and all that stuff, instead of relying on like a promote or like a refi, to kind of fuel your growth. So, that the fee base kind of just spreads people very thin. So, for us, then, when we bring it in house, we can kind of design this system from the ground up. There is like no like minimum charge, for example. Like a lot of the firms, they're like, yeah, we'll do like 5 or 6%, but like our minimum's like 2,000 a month. And like on a smaller property, that's like 30% of the revenue. And you're like, wow, that's a lot of money. It's no longer the 5%. So kind of designing that right size solution.
Yeah, and I think, for this space in particular, right? And I know because you were a real estate agent, you were an LP in other, multifamily investments. You worked at a real estate fund and you know other asset classes. In other asset classes, it's commonplace to find third-party managers who are very competent and capable of handling that asset in a lot in secondary, tertiary markets across the country. You can find that process is pretty much the same, right? But in this business where there's so many different variables, right? Whether it's tenant-owned homes, right? Whether it's park-owned homes, whether you're selling homes or you're doing infill, there's so many different variables. Having third party or proficient third party managers in some of these markets is very difficult to find, and it becomes the almost the moat around the business, right? Because of that, like you're not just an asset manager if you're in this space, you're also an opco, right? You're property management, you're a retailer if you're selling homes. When as you're and you're making that transformation into that, I mean, what systems did you have to build or build first? Like, how did you look at that property management piece in terms of developing that and building that out?
So when you or okay, I'll speak for myself. When I kind of build something out, I want to get competent at that thing first myself, so I know what good looks like. So there was a period of time where all the tenants had my phone number, and my phone is blowing up with like maintenance requests. I'm like reaching out to people to like pay rent and all that stuff. But after a while, I'm like, all right, hang on, I can't be doing this forever. But I know it enough to know, okay, here's kind of what the problems day to day are. Here's where the friction points lie. Here's where the bottleneck is. And like, how do we design a system that actually makes sense? So then, bringing in like partners and then people that can like help build out that aspect and help like, you know, implement the vision, so to speak. That was crucial for me. Um, but yeah, I mean, I think property management is one of those things. You're right. It's tough because bills get paid with dollars, not percentages. And I think people get into this mindset of like, oh yeah, like uh, PM fee is comparable in multifamily, right? We pay like 3-4%. Well, yeah, 3-4% on an apartment building. That's like 100K a year versus, I don't know, like 6-7% in a mobile home park. That's like a few thousand a year. That's like more than 10 times less. That's like exactly. So how do people make it work? It's tough. I mean, it's how do you do a lot with a little, right? How do you make the best choice out of all the imperfect options out there? So that's kind of like the problems that you have to solve when you're building this thing out.
Yeah, and I think you said something or a few things in there that are so key to people because because you're not dealing with the same variances in each park, you have to figure out the best option to make it work out of those variables, right? So that you have to empower your people on the ground to be able to make some of those decisions and give them a playbook or recipe of defining what good looks like, right? So ultimately, I want to get here, and then getting the right people with the right processes where they know they can make some audibles if necessary. But here's what good looks like, right? Clearly defining what good looks like. And I've heard you mention this before, that you operate on an EOS based system. And for those who are unfamiliar with that, that's, if you've read Gino Wickman's book, Traction, which I think if you're an entrepreneur, you're in business or have a small business, you should absolutely, it's probably a must read. How do you think that that's helped you in building your company, right? And building that out? And how do you use that to work on some of these fixes?
Mhm. I love systems that are already built. There's the saying, if it ain't broke, don't fix it. So having a system like EOS is like a management system in a box. A lot of different companies use it across different industries to kind of get the team aligned on a vision. They kind of know what their work is going up towards and what good looks like for them. Everyone has one number, kind of one measurable KPI that they're responsible for. And because the whole system kind of flows up, everyone kind of has their own space. Like, you're not overstepping your boundaries, you're not being inefficient with your time. So I think having a system like that is super helpful. I'm not one to have like the need to have my imprints on everything. Like, I don't need to design every single system. If it works, we'll stick to it. We'll try to implement it. If it doesn't work, we'll make some tweaks as needed. So I think that's the difference. For me, is like, I aggressively set aside my ego, and I always think like, what does the team need? What does this business need? And just do it.
That the the challenge in that, right? Especially when you're a entrepreneur, or type A person, or whatever, however you want to define it, is you see a problem, you want to fix a problem, right? So
Yeah.
the first response is, all right, I'm going to run in and fix it. But as a leader, or as you're growing, you have to realize where you have to step back. And I always think of when something happens like that in my organization, right? If you have ever seen the show Band of Brothers, right? That series where Captain Winters, who now became a major, and there was that they were running in and they were taking over, they were taking over the city, and the lieutenant just stops, and his first instinct is to run into the battle, and he had to be pulled back by the general and say, no, you need to get back here. And he had to find somebody else to do it and let them lead the charge. And obviously, that's a wartime scenario. But I think from a business standpoint, the lesson I took from that was, you cannot be effective always being the person running in to try to save the day. You have to make sure that the system works and somebody else is able to step in, because that's how you grow leaders and really build an organization. And using systems like EOS allows you to do that, identify where the roadblocks are, make sure, see who's, if every you have people in the right people in the right seats, so you could move the company forward.
Mhm.
And I think that's just such a key, that's helped us grow, right?
Yeah.
Since we put this in
Yeah.
place, I think it's really helped us to see where those bottlenecks were.
Yeah, and I think it is a common kind of problem that entrepreneurs face. I mean, across the industry, like, not just our space. That it's like they feel like they're imprisoned by their own business, and that's just because they are the bottleneck for a lot of things, right? I think you have to be aware of like what kind of lies on your back versus like what lies on others' back. So you want to, as much as you can, I mean, if you want to build a business that can run without you eventually one day, like, you want to make sure that the bottlenecks, the decision points are within the system. Like, it's not on you specifically, and that's how you grow.
Eh, Great point. Great point. Now, Leo, I know I guess you were a philosophy major, and so I'm going to ask you, I'm going to ask you a question because of here you said this philosophically
Mm.
that the window in the MHP space is closing. So I see you taking a deep breath when I said that, right? But why do you believe that the window is closing in the MHP space?
Mm. So, first off, I was a finance major, and I liked finance because it kind of combined philosophy and numbers. It's like the practical application of it. Like you kind of see a business, flourish and like manifest itself based on like certain principles. But yeah, I mean, as far as the opportunity for mobile home parks, I mean, it is getting tighter and tighter to get a good deal. So there's two components of a good deal. You have to buy it right and you have to run it well. So to be able to buy it right, there's just more and more entrance into the market. So I mean, like from, 10, 20 years ago, there were the ELSs of the world, the Sun communities, like they basically had the best, the cream of the crop communities, right? And they always had funding. More and more large institutions, they're like, oh wow, this is a great asset class. These are like coupon clippers, blah blah blah. Like Fannie likes it a lot, like the agency lending. So they're creeping down, and then as they're kind of institutional deal flow kind of dries up, they creep into like the middle market area. You have smaller like private equity shops that are backing emerging sponsors. They're like, hey, help us deploy this capital. So like that's creeping down here. And then from the other side too, so you're seeing a lot of kind of individuals entering the market as well. The people that were fixing and flipping their homes, they're maybe contractors. They're like, wow, okay, mobile home parks are a great opportunity. They're heavy in cash flow. I want to do it. The people with like creative financing, they're like, hey, I want to buy a mobile home park with zero down. Let me know if you have a deal. Like these people come up, which, for better or worse, it's just like it clouds the expectations of the owners. And we have in our team, like we have deals sent by brokers, but then we also have direct to seller outreach, and like we're just talking to the sellers. It's very different than even a few years ago during COVID. Like some of the previous notes that we had, like they were much more reasonable, and now they're selling for like, or they're under contract for like 30% more, 40% more. And when you talk to them, they have these pie in the sky numbers because they're just like shrouded by I guess cold callers and like offshore people and stuff like that. So it's harder to find a good deal that pencils because the arbitrage between the value and the price is getting smaller and smaller.
And and I still believe there's like an asymmetrical risk return ratio in this space. But to that point, what's happened is the capital that's pouring into the space is just changing the basis level. And, when we first started buying communities over a decade ago, we could go into a situation that was run by an independent that had under market rents, and we could underwrite conservatively to say that we're going to do this, years worth of improvements, whether it's to maintenance, to the grounds, to the beautification, and show people what we've done. And then when we said we've got to get us closer to market and start doing those, guiding those rents closer to market, there was a lot of community acceptance because, wow, you fixed that pothole, you got rid of the hazardous conditions, the troublemakers that were in the community are no longer there. The culture has been elevated. The community is a lot cleaner. I want to be here, and new people would come in and want to pay market. And because the economics have changed, that runway of 12 months that used to exist doesn't exist any longer. So
Yeah.
here's where I would challenge. It's not that there's not good deals available. It's just the deals have to be almost looked at differently because
Mhm.
to your point, they do not pencil the way they used to. Like, does that change your underwriting expectations now? Like when you're going in, What are you looking how are you looking to create that value and set that expectation? Is it an investor expectation, conversation with them day one? Or is it, an expectation of how we're going to treat the asset? Like where does that fall for you?
Mm, so it's interesting because I think there is never kind of one finger to point like, oh, okay, that's it. It's more so like a consortium of options. It's like, hey, it's like 30% based on like setting the right expectations with investors. Maybe it's like 40% like buying it right, having the right business plan, like setting aside enough budgets for capex. So yeah, I do think it is important to have the right business model going in. And so for us, we haven't really changed our underwriting too much, and that might explain us not doing too many deals. But we did just ramp up our seller outreach and try to kick up more opportunities that way. However, when it comes to the actual operations for the community, I mean, you're right because there's less spread, more upside is being priced in. Your kind of margin for error when it comes to execution becomes smaller and smaller. So when there's a budget surprise, you're like, well, okay, well, maybe this would take away from that. How do you like manage it? How do you do what's right by your residents? How do you make their lives better? So it's an ongoing kind of question that I'm asking and answering myself.
And I know you do a lot of, um, you value add. You've talked about, your infill process, how you're adding value to community. Walk us through, a typical, good opportunity for Cornell communities. Like, what are you looking for? Target market, property size. Like, what's your and I don't like using the term buy box, right? Because I think buy box is constrained, but it's more of a buying filter, right?
Mhm.
So let's like, how do you
Yeah.
filter out an opportunity?
Yeah. So great point because we were just talking before we hit record, like kind of the buying criteria. It's never like, hey, if it's not within this, we're not interested. It's more like kind of a pyramid with tiers, right? Like if this checks all boxes, if it's like city utilities, if it's like 50 plus units, like growing market, it's like great. We can get really um, optimistic with our underwriting and like we could give a really good price as opposed to like, oh, if it's like, I don't know, like treatment plan, this, that, the other thing, you're like, the price has got to be super convincing to make it make sense. So, for us, like we have some assets, in New Jersey, we were saying, and it's just changed our philosophy. There are like some regulations that pass. So now, we're looking more in the Southeast and the Midwest. So the Southeast is good because population growth. There's like a lot of opportunities. The income is growing as well. So we're able to also milder weather. I think that's something that people don't really talk about. In the Midwest, it's brutal. I mean, you have like tornadoes, you have like storms and like freezes, and it's like, oh man. So I think knowing kind of the patterns and how people think, how residents think, right? In the Midwest, they're less sticky than in the Southeast because in the Southeast, you have so much going on, right? We have a property in Virginia. Like, hey, look, there was a Lego plant that just like came along. So there's going to be more jobs in the area versus like in the Midwest. Like, what's going on over there? I mean, you're just paying a lot in insurance because like there's just like weather events. So learning what good looks like and factoring that in. And I'll end with this, Frank, is that as far as a certain business model that we like, it really depends. There is no kind of bread and butter. I think if we can buy right and the property is stabilized, that would be amazing. However, infill deals, like certain level of value add, like hands-on work, we're not necessarily afraid of that, but more cognizant of what the bandwidth with our team is, because we're building our team from the ground up, and it's like, all right, how much work is on everyone's plates? How much work can we handle? We can handle maybe a couple value add deals, but not more than that. So once we stabilize one, then we have room for one more. So that's how we think about it.
Yeah, we've looked at because we've talked about the different variables in this space. And so when you typically, the major metros are trying to move away from MHP. I mean, you're competing with developers for that land that are going to convert it into, luxury apartments or maybe what they think might be a higher and better use. So, we've looked at two different segments. Like we have a park that might be physically occupied, if not economically occupied, right? So, if that's physically occupied with homes, maybe 80% of the lots are filled with homes already, even if those homes are not occupied, but they need some work or they could be salvageable, whatever the case may be. The surrounding area, I could be a little less, it doesn't have to be as strong economically because the homes are there on site already. And then the second bucket really is an infill, right? So if I have to bring in new homes to fill up or activate those empty lots, I need a different set of economic um, numbers to work in and around that community for that community to work, right? So we've kind of try to filter out deals from that or for opportunities along those lines,
Mm.
and then we can drill down and we have kind of at this point we feel like we have some data sets to know what works and what doesn't. So if it's an infill opportunity, but the median home sale price is $125,000, um, and I've got to bring in, 50% of those 50% of the lots are vacant, that's not going to work, right? At least not as an infill, right? It has to work
Mhm.
on what's there existing.
Yeah.
So,
Yeah.
we've kind of tried to filter out, based off of, to your point earlier, like every community is a little different. Like what buckets does that fit in, and what do we need to see it happen to have those good outcomes?
Yeah.
Um, that
Yeah.
that that for us has been really key, really
Yeah.
key.
And I will add, Frank, that yeah, it's not necessarily like a buy box of like what works and what doesn't. It's more so like questions to ask yourself, like a checklist, right? That you as the buyer operator, you go through and you kind of figure out like how much do you like this deal? How likely is it to work out? And that is also ever changing. I mean, as we know, the cost to infill is going up more and more and more. And
Mhm.
to the point that, even if we sell a unit at cost, is it worth it? And can the market bear that kind of cost, right? Because people like the residents, they think in terms of monthly payments. So what's that monthly payment look like for them? How attainable is it? And how long do you have to market the unit to find the right resident?
It's not the price of the home, it's the cost to be in there that I think is more important for a resident. I think that's a great point. You hit on something. You said something before, which and I look at this, and I respect it because it's a discipline. Like you said, your buying has slowed down a bit. Like you're actively looking, and I think that for opportunity, but you haven't just acquired. And you see people who just acquire to acquire, but you've maintained that discipline, um, to make sure that you're buying right. Like
Yeah.
how, and I know I guess it's in our DNA, right? We like that hunt, right, to find something new. But how is it that you maintained that discipline? Like, what's the principles that must be there for it to work for Cornell communities?
Here's where it's going to sound very interesting, but so it's a kind of cocktail of reasons, but one is that I truly think, and like my team believes this, that we need to take care of our investors and their funds, and we treat it better than our own. And to that extent, I know like when it comes to looking at the incentive structure, it's kind of a bit perverse because like a sponsor, like if you're doing a syndicated deal, like you have to buy more deals to bring in more acquisition fee, more income and stuff like that. But what's that end story look like for the investor? And to us, we didn't want to make our underwriting more optimistic just to do a deal. And, to get to the center of it is that I'm okay to eat dirt and not see the fruits of my time for a long time because I'm super frugal. I don't need a lot to live. And that has, in effect, given the company more runway to not have a deal. And I really don't mind. I mean, I have other investments. They kind of pay the expenses. So, like, I'm okay. I'm not in like an existential need to deploy capital to earn those fees. So, I think just being okay to live minimally and like find the right opportunity. But I mean, the constraints are just like investors are always like, "Leo, when's your next deal? When's your next deal?" I'm like, "I don't know. Hurry up and wait. Get in the wait list. I'll let you know."
Yeah. So are you working on anything right now? Have you found, what have you found in those conversations that you're having right now with sellers and or brokers?
So there are a couple deals that we're pursuing right now, but when it comes to diligence, it's always like kind of a checklist, kind of a journey to the finish line, and like we're kind of uncovering stones and figuring out like, okay, can we live with this? Do we have to update the pricing, or like how do we still make the business plan work as we uncover these things? So yeah, I mean, there's some like earlier stages of the conversation.
So, and to your point, I mean, in our conversations with sellers right now, I think some of them are set or pegged at different valuation models, right? That's one challenge, and
Yeah.
but we do see. I think the opportunity set has gotten a little bit better because people who've wanted to exit over the last 2 years, I think they've been through either retrades or not being able to get financing or unrealistic expectations. So you're starting to see a more realistic
Mhm.
uh set. I don't think it's going to be like 20 or 21.
Mhm.
But I am starting to see the opportunity set open up a little bit,
Yeah.
where pent up seller demand, because I do think that sellers need to transit. I mean, people have change of life,
Sure.
meanings. And I do think that we're starting to see some opening in the markets. And we're anticipating deal flow to kind of open up over the next 12 months, and I think good deal flow, not just any deal flow. Because to
Mhm.
your point, we've done less deals. We just think we've done better quality, right? We've been very happy of the ones we've been be able to execute on, but we just haven't done the same velocity.
Mm.
Um, so being selective, I think, is really important, especially for any operator, for any sponsor. The last thing I want to hear from if I'm investing with somebody is that they're doing deals just to do deals.
Yeah. Yeah. And one interesting point that I want to say is sort of as the margin for error, gets smaller and smaller, like there is opportunities, there is and always will be. But your margin for error in terms of like the price arbitrage or like the business model, it gets tighter and tighter. You kind of see this across different asset classes that it's very hard for people to properly price in the systemic risk. Like when it comes to multifamily, like when the interest rates change, like like tons of people, tons of operators, they're getting swept up. Or even like when you're talking like big boys in New York, like I have a lot of like lunches with like people in like these large companies, and they're doing like cash and refinances for like huge like $100 million buildings and stuff, and like these deals are going bust. I don't think people are factoring in like the true underlying risk. Like I mean, the Hormuz situation, like who's really predicting that in their model, right?
That's a great point, and I think where this industry really sets itself apart is this is truly an operator's business, right? This is not a fix it and forget it business. So if you're, especially as the price points are becoming elevated, like if your basis is 12,000 a lot, for argument's sake, you can there's a lot of runway for error, right? Because you're at such a great basis. But now that those numbers have doubled or tripled in some cases as your entry point, even for value add, to your point, the margin of error is less. It really becomes more intrinsic to be an operator who understands the trenches and can figure out where they can create value faster for both the residents and their stakeholders to make the deal work, right? Because if you're going to pay more, then speed and efficiency is everything, and that's a key component to this.
Yeah, you're absolutely right, Frank. And in terms of the operations, that's kind of what we want to build to as the team grows is going back to an earlier topic of just managing the operations at a property. You'll see some people, they let their on-site folks do a lot more things, like their on-site manager do more things. And for us, we're very kind of we're centralized in terms of our operations. Like, we want to build as much as we can, like systems, playbooks, all that stuff. Like, we want our offsite team to handle as much as we can, because that sort of insulates us from the different variables that could come up. And to get the alpha in the space nowadays, it's becoming more and more operational heavy. It's like, yeah, I mean, like, you can get a deal at a fair price, but like, your upside, how you create value for the residents, for your investors, is through operating it well.
So, and how are you centralizing that system? And I know you mentioned before we started recording, you're implementing AI. You're like, how? What are you doing? Are you using VAs? Like, how are you structured your centralized team? How is that set up?
Yeah. So it's a combination of building good SOPs and good playbooks, so people know what to do, and having kind of just like, for example, like monthly inspections, like they're uploaded to the folder. Like, another person has a checklist, like, is this being done? Is this being followed up on? Is this created into tasks into Asana, or Rent Manager, or something like that? And then how do we see the follow through for it? So yeah, I mean, absolutely. And when it comes to the team, yeah, I mean, I think for the most part, bills are paid on dollars, and the call it the dollar amount that we're playing in, we don't really have a lot of money for all onshore people. So we do have like a decent amount of like offshore people, but it's not to say that they're any lesser than. I mean, they're just regular people. But it does put the onus on you as the system builder, as the leader, to be that much more clear and that much more explicit in your processes. So it actually makes you a better person, because you have to be able to explain something clear enough and to monitor it well enough, instead of like, oh yeah, go do this, and like expect them to know how to do it.
Having that clear communication of defining again what good looks like and exactly the steps that have to happen, and what that should look like with clear ownership of who's responsible for that is so mission critical, especially as you're talking, whether it's a VA or like they've never been on site. They may have never even seen a mobile home park or know what that looks like. So, to be able to clearly communicate that is such a key component to any business's success. So,
Yeah.
last question,
Yeah.
um, what do you think, for people who are not familiar or just looking into, because you mentioned people looking to come into the space now or looking at the space now because all of a sudden now it's a buzzword, it's a keyword, they see people being successful. What do you think is the biggest misconception that investors may have before they get into the manufactured housing space?
So it's definitely the expectations. It's like, I think it's just poorly set on how hands-on a community is, because when we talk about the business model to passive investors, they're like, yeah, okay, like, the residents, they pay lot rent, it's a very simple business model, you're not managing like an on-site leasing staff, you're not managing like roof repairs, like, in multifamily and stuff like that. Just like, hey, make sure that the utilities are fine, and you can do it. And that actually, because there's so much content out there for that, it sets the wrong expectation to people that want to do it themselves. They're like, oh yeah, I think just like give them a payment portal, they're gonna pay on time. Like, I don't need to chase them. Like, these utility things, like, they're fine, right? I'll just cash flow. And it's just like poorly set. And like, I have spoken with, like, even some of our investors, like, they want to become like GPs themselves, and like, I'm happy to be a resource. And I was like walking them through like kind of day to day what I'm doing, and the person's like, "Oof, I do I want to do this? I don't know." So yeah, the expectation of operations is so important to just like understand what you're walking into.
That's such a important point, and I think a big misconception in the space, that even if they own the home, there's so many touch points that you need to maintain with that resident, because ultimately you're building a community, and you cannot build a community and have zero attachment to it, right? So you have to, the resident has to feel that you're attached, or your management is attached to those outcomes. And so there's so many different touch points that you have to run to maintain that for this quote unquote passive investment. So Leo, what is next for you guys and at Cornell Communities? And if somebody wants to find out more information, wants to learn about your process, what you do, how you do it, and find out more, where would they be able to reach you?
Yeah. So as far as next steps for Cornell Communities, I think it's more disciplined growth, just being sensible when it comes to these things. Part of why like Cornell is part of our name. It's just like we want to go it the sensible way, the smart way. We don't want to get ahead of our skis, bite off more than we can chew, that kind of thing. So we will have some deals, not very often, but if you want to learn more about our team, our philosophy, maybe joining our investor waitlist, check us out on our website, Cornell Communities. So it's CornellCommunities.com. Or if you want to reach out to me directly, I'm happy to be a resource where I can. You can find me on LinkedIn at Leo Young. That's LeoYoung, or on Instagram at Leo Young Real Estate.
Follow Leo Young on LinkedIn if you don't already. It's he documents a lot of what he's doing, and the successes and challenges in business, which is great. And if you want to learn about the MHP space, it's a great place to look. Leo, I wish you continued success for you and Cornell Communities, and look forward to continuing the conversation. And for those of you listening, I have one question for you. Would you help someone you don't know find, fund, or operate their next real estate investment? And if your answer is yes, then rate this episode on whatever streaming platform you're listening below. And if you do that and send that to the Mobile Home Park Exchange, what I will do is I will send you a copy of our after site visit report. It's the same report that we have our team fill out when we go down and do a site visit, sends it back, keeps our on-site manager, maintenance people, everybody on point and moving forward to execute the business plan. So if you rate this episode, send it. That's how we get to more people in the algorithm. And that'll be our gift to you. Thank you for listening to this episode of the MHP Exchange podcast. Until next time, everyone, happy investing.